In 1997, you could have bought Amazon stock for $18 a share. If you'd put in $1,000 and just never touched it, you'd have over $2 million today. Sounds like a no-brainer, right? Just buy growth stocks, get rich, done. But here's what nobody tells you: 2 years after that IPO, Amazon lost 95% of its value. If you'd invested $10,000, you'd have watched it shrink to $500. Most people who bought Amazon early, sold in a panic, years before it ever became the company we know today. So which is it? Do you chase the next Amazon and risk losing almost everything? Or do you play it safe with boring dividend stocks that just pay you cash every quarter? Before we get started, make sure to like this video, subscribe to the channel, and turn on the bell notification so you never miss any of our future videos. Let's start with growth stocks. A growth stock is a company that takes its profits and pours them right back into the business, instead of paying you a dividend. That money goes toward expansion, research, new products, hiring. Think Amazon in its early years, or Nvidia, or Netflix. They're betting that reinvesting today creates a much bigger company tomorrow. We already saw what Amazon did. $18 a share in 1997, adjusted for 4 stock splits down to about 8 cents a share, turning a $1,000 IPO investment into somewhere between $1.5 million and $2 million today, depending on the exact date you check. But Amazon isn't even the most extreme example out there. According to the Motley Fool's own stock advisor track record, $1,000 put into Nvidia back in April 2005 would be worth well over $1 million today. $1,000 into Netflix in December 2004 would have grown to roughly $400,000. These are staggering numbers. But every single one of these companies went through brutal, multi-year stretches where the stock fell by 50% or more, and plenty of investors bailed out before the real growth even began. That's the hidden cost of growth investing. It's not just about picking the right company. It's about surviving the 60, 70, even 90% drops along the way, without flinching, sometimes for years at a time. Now let's flip to dividend stocks, and this is where the story gets a lot less flashy, but arguably a lot more powerful. Usually, a dividend stock is a company that's already mature and profitable. Instead of reinvesting every dollar back into growth, it pays a slice of its profit directly to shareholders, usually every quarter. Think Coca-Cola, Johnson & Johnson, Procter & Gamble. Here's a number that should stop you in your tracks. Research from Ned Davis Research, tracking data all the way back to 1972, studied S&P 500 companies based on their dividend behavior. Companies that started paying dividends or grew their dividend over time returned an average of 9.6% per year. Companies that never paid a dividend at all returned 6.7%. And companies that cut or eliminated their dividend entirely returned just 2.3% a year. Read that again. The companies disciplined enough to keep raising their dividend, year after year, through recessions and crashes, actually beat the broader market, and they did it with far less volatility than growth stocks. Now let's make this real with one company, Coca-Cola. Warren Buffett's Berkshire Hathaway first bought Coca-Cola stock back in 1988, at a split-adjusted cost of roughly $3.25 a share. Coca-Cola has now raised its dividend every single year for 64 years straight, making it what's known as a dividend king. Today, Berkshire collects about $2.12 per share every year, just in dividends. That means Buffett now earns back his entire original investment in Coca-Cola dividends alone roughly every 18 months. No stock sale required. Just the check that keeps arriving, every quarter, getting bigger every single year. For 71 years straight, from 1938 all the way to 2008, GE never cut its dividend, not even once, not even during the Great Depression. It was considered one of the safest blue-chip stocks in America, the kind retirees bet their entire retirement on. Then in February 2009, in the middle of the financial crisis, GE slashed its dividend by 68%, from 31 cents a share down to just 10 cents. Its stock price had already collapsed from over $41 a share in October 2007 to just $6.66 a share by February 2009. One real investor, a semi-retired lawyer named Jim Labama, used to collect roughly $69,440 a year in dividend income from his GE shares. After the cut, that dropped to $17,440. Years later, GE cut the dividend again, all the way down to a single penny per share. Labama's dividend income eventually fell to zero, and at 78 years old, he said he'd probably have to go back to work. That's the risk nobody talks about with dividend stocks. A safe dividend can vanish overnight if the underlying business is actually in trouble. Chasing a big yield without checking whether the company can actually afford it is exactly how retirees like Labama got blindsided. So which one actually builds more wealth? Dividends or growth? Here's the honest answer: it depends on something most people never even ask themselves: how long can you actually hold on, and how much pain can you stomach along the way, and are you actually checking whether the company behind your dividend is healthy, or just hoping it stays that way? If you have decades ahead of you, nerves of steel, and can genuinely ignore a 70% drop without selling, growth stocks have historically produced the biggest possible returns. That's just the math, and Amazon, Nvidia, and Netflix prove it. If you want steadier compounding with less drama, dividend growers like Coca-Cola have quietly outperformed the market for over 50 years. But GE proves that dividend stock doesn't automatically mean safe stock. The real signal isn't the size of the dividend. It's whether the company has kept raising it, through every recession, for decades, without a single interruption. The smartest investors don't pick a side. They blend both. A little bit of growth for that big potential upside, alongside proven dividend growers for stability and cash flow that keeps arriving whether the market is up or down. If you find this video helpful, do not forget to like the video, subscribe to the channel, and press the bell icon so you don't miss any future videos. Thanks for watching, and we will see you in the next video.